Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of the foreign mutual fund and foreign ETF, what that means from a U.S. tax and reporting perspective, and what that means to you as a filer, what you can do about it, and how you may be able to avoid some of the more heavy tax implications of having a PFIC. So first, let's start with who has to file the form. When someone has a PFIC, unless an exception, exclusion, or limitation applies, then they generally file a Form 8621 with their tax return. U.S. person means U.S. citizen, lawful permanent resident, foreign national who meets the substantial presence test. Domestic companies may have to as well in domestic trusts, but for purposes of this presentation, it's just going to be individuals. If you're an individual and you have to file the form, depending on whether you may qualify for an exception to substantial presence or one of the treaty elections to be treated as a foreign person for U.S. tax purposes, may impact whether or not you actually have to file the form, whether you can qualify to file a Form 1040-NR with an 8833 treaty election and avoid having to file the 1040, the 8621. The Form 8621 is a type of international information reporting form, and there's lots of different forms. There's the FBAR, Foreign Bank and Financial Account Reporting, FATCA Form 8938, you have 3520s for foreign trusts and 5471s for foreign corporations, but the 8621 is used to report PFIC. PFIC typically means it's a passive foreign investment company that has 75% of the income, 50% of the assets are passive. If you fall into either one of them, it doesn't have to be both, either one, then you fall into the PFIC predicament. Oftentimes, when people talk about PFICs, they're talking about funds, foreign mutual funds, and foreign ETFs. Now, there's lots of different flavors of PFIC. You may have a holding company in a foreign country that hold, like you may be in Hong Kong and have a Hong Kong private limited, or you may be in Canada and have a Canadian corporation where a majority of the assets or a majority of the income is passive, and it falls into the PFIC scenario, but more often than not, it's the foreign mutual fund. Why? Because the fund itself is considered its own type of corporation with its own type of management, even though you don't see it that way as someone who's acquiring a unit. Why would you, right? But from a technical standpoint, they meet the qualifications of a PFIC, unless sometimes it won't. Like it might be an insurance company and a mirror fund, which is just an internal fund designed to mirror a different fund. Like maybe there's a mirror fund at an insurance company that's designed to mimic or mirror like VTI or something along those lines, or the VT-SAX, the mutual fund equivalent. When you have foreign mutual funds and you meet certain threshold requirements, then you may have to file the 8621. So it's a little different than the FBAR. So for the FBAR, it's for foreign accounts and if you have more than $10,000 in any given day of the year. With PFIC and Form 8621, it's only filed if you don't meet one of the exceptions. So, for example, if you're married filing joint and there's no excess distributions and there's $35,000 worth of foreign mutual funds, then you may not have to file it because you're below the $50,000 exemption. If you're single or married filing separate, it's $25,000 exemption. There's a few different things to consider, even if you're below the exemption amount. If you have what's called an excess distribution, then you do have to file the form under most circumstances, despite the fact that the value of the funds may be low. So when you're looking at the Form 8621 and foreign mutual funds, the first thing to consider is it a PFIC? So let's assume it's your typical mutual fund and it's a corporation, and therefore it's considered to be a PFIC. The next thing you have to look at is what's the value. Is the value above $25,000 or $50,000, depending if you're married filing single or separate versus married filing joint? If it's below, then you may not have to do the form, or you may just do part one of the form. There's a bit of a disparity between the regulation and the instructions. One makes it sound like you don't have to file at all. One makes it sound like you have to file part one. But there's no monetary penalty for 8621. It just means that the tax return remains open, which is not a great thing anyway, but it's not one of those $10,000 per year FBAR types of penalties. So assuming that you're under the $50,000, $25,000 amount, if you have an excess distribution, then you have to file it. So when you're looking up things like foreign mutual funds and ETFs, a common phrase you'll find is excess distributions. And what that essentially means is if in the current year the amount of the distribution exceeds the average, 125% average of the 3 prior years, or less if the fund was open for a less amount of time, then you have what's called an excess distribution. And if you have an excess distribution, then you have a lot of tax filing you have to do. You have to do this attachment to the 8621. They don't really provide the form. You could typically find one online, but it's much more complicated. You pay a very high tax rate. So with foreign mutual funds, what makes it different from a domestic fund is with a domestic fund, you're not paying any additional tax rate, right? If it's qualified dividend, you get qualified dividend treatment. If it's long-term capital gain, you get that type of treatment as well. When you have a foreign mutual fund, it doesn't really work that way. When you have a foreign mutual fund, if it's an excess distribution, then you're paying the highest tax rate that was in play for any year that you held it, other than the current year where you pay your progressive tax rate, whatever that may be. If they're not excess distributions, then you don't pay that same tax rate, but you typically don't get qualified dividend treatment. If you have foreign mutual funds and ETFs, you may want to consider making an election. If you make the election in the first year, that's great. If you don't get to make the election in the first year, then you're making a late election, and you may have a purging election where you have to go back and do the excess distribution calculation up to the point that you make the election. Some people may qualify for reasonable cause, and so they're not making a late election per se, but reasonable cause in the realm of ETFs and more mutual funds is way different than it is for things like FBAR penalties and things like that. It's very difficult to prove reasonable cause when you're doing PFIC. A few facts to keep in mind when you're doing this. If you're going to make the election, make it early. The two main elections are the QEF and the MTM, mark-to-market qualified electing fund. In general, the QEF is going to be the better election, but it requires cooperation from the foreign financial institution, which may be very difficult for you to get. The mark-to-market doesn't require that, but it doesn't derive the same benefit that you get from the QEF. With reporting, if you have all of the mutual funds in an account, let's say, right, you have a portfolio account with 10 funds in it and a main number. For your FBAR, you generally can just report the account number and the total value of all the funds because you don't have to parse out items for the FBAR. For PFIC, it's a little different. For Form 8621, you have to establish the basis for each one of your different funds. So you generally have to report each one individually, which can be difficult depending on what country and what type of funds you have. You generally have to know the value, if there are any distributions, any taxes paid, things like that. The $25,000, $50,000 exemption or exception is the one you'll hear often, but there's another one that may apply too. It's part of a regulation. I think it's 1298, which basically says if the PFICs are part of a pension type of trust situation with a treaty country, then you may be able to avoid having to parse out the PFICs on 8621s. Instead, you would just report it how you typically would, which would mean FBAR, FACA, and possibly 3520. If all of this is news to you and you didn't file this in prior years, the IRS has various programs you can use to get into compliance. There's VDP, which is for people who were willful. There used to be OVDP, but they merged the programs back in 2018, and OVDP was an offshoot of VDP, and even non-willful people would do it sometimes to avoid the headache of a potential audit. It doesn't really fly under the new version of the program. It's really just for people who are willful. If you're non-willful, you have a lot of options available to you. You've got the streamlined procedures, you've got delinquency procedures, and possibly reasonable cause. We got a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter, and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.